Good morning, ladies and gentlemen. Welcome to Traders Podcast. Today we have the January 28th, 2016, one day after the Fed meeting, and we start with a brief overview of the outcome of yesterday's Fed meeting. So basically nothing important happened. The Fed kept the interest rate where it is, which is a band between 0.25% and 0.5%, and effectively the Fed interest rate at that moment is 0.36%. So there was no change in interest rate. This was the first outcome of the meeting, which was expected by the marketplace. And the second point was that the Fed mentioned that in the future, for the future interest rates hikes, it will consider the volatility of the financial markets, the volatility of the economic development, also the international development, not only the development in the United States, but also in the international environment. And this was not new, because the Fed mentioned that already in the statement of December. So this was another interesting point. The next point was that we have a slightly dovish tone in terms of future hikes, which means that in summary the Fed is stepping back from the idea hiking the interest rate in March or April, and now the mood of the market, or the expectation of the market, is that the Fed will do a rate hike earliest in the second half of 2016. There is already chatter that the Fed won't do an interest rate hike in 2016, but at that moment the most probable outcome would be, as of today, to hike in June or maybe in September. This is at the moment the current stance of the monetary policy of the Fed. So the market reacted quite differently. We see, I have here the DAX future on a daily basis. What would be or what is probably more interesting is the S&P 500. We saw after the Fed, the market was disappointed and sold off a bit. We closed down more than 1%, which is a little bit of disappointment. Obviously, the market, or the Fed, was not dovish enough to keep the markets calm, and so we had this disappointment move after the Fed meeting and within the night. So at that moment, you see it, here's a real-time chart, the market is recovering nicely. So we are slightly below 1900, and there's a good chance that we get it back by today, because in my mind the Fed statement was positive and was dovish, so it was good for the stock market. And keep in mind that the Fed is interesting in having a good performing stock market. So this was the first part of the video, the Fed meeting. The second part is we will have a look now at the seasonality as we are approaching the end of January, the end of first month of the year. We will have a look at the market, which how it is typically behaving around this month, change of the month. And here's the DAX, which is the future markets, and here I brought a seasonality trend line, if you want, seasonality indicator, which shows us the typically ups and downs of the marketplace. It's not necessarily that we have here, if you look at this, maybe this is a more interesting view, compressed view. It's more or less the turning points, which are here. Here was a turning point, and here was a turning point. It's not typically the direction. Here we have indicated the downward direction of the market, and the market really declined. And here we had indicated an upward direction, and the market indeed went up, but only to this point, and then the market fell back. So how I use seasonality is not typically in the way that I anticipate the market direction, like here or like here. I try to use the turning points, which are indicated, some like here or here or here or here, to analyze possible turning points in the marketplace. And at that moment, we are here in this seasonal low, and which is probably a good, it was probably a good indication for the market really to turn. And now we see that this red line is increasing, is going up, and that means that the market is supposed to rally a bit, at least until the start of February. This is a seasonal phenomena which is not only observable in January, February. It's also observable most of the months, in most of the months. So we mostly have a slightly upward bias in the marketplace. So I wouldn't be too surprised to see the market going up in the next couple of days. And then it is very important that the market is, if you look at the DAX here, but the S&P looks pretty similar, then it is very important that the market is not falling below this very nice and this very big support line here, which is 9,300 something points in the DAX, and it is approximately 1,920 points in the S&P 500. So this is a very important support, and it should not be broken for the rest of the year. That would be very nice, because this here and here, the lows in August and September, those are the lows of the previous year, and it's not good if the market falls through the lows of the previous year in the first quarter of the new year. This means trouble, and so let's hope that the market will defend this support line in February. At that moment, I think that a short-term rally is in the cards, and that is more likely than a short-term sell-off, especially with the boost of the, in my mind, slightly dovish Fed meeting. And so I wouldn't be too surprised to see the markets going up, and I would use now the volatility, especially the volatility on the downside, to go long with a short-term trading position in the index futures like the DAX or the S&P 500, and hold it until the first or the second trading day of the week or of the month, February, which is the next week, Monday and Tuesday, and then hopefully make a profit. But I will keep you updated on that, and that was it for the day. We'll see you later, and have a nice day and happy trading.